But just as banks are bracing for a potentially worsening downturn here, the Federal Reserve Bank of New York announced yesterday that it would be dialing back its repo operations, potentially taking the foot off the gas there in supporting short-term liquidity in the financial markets. So potential optimism on that front. And for more on that, I want to bring on Yahoo Finance Fed reporter Brian Cheung, who has more on that, as well as a very special guest for us today from the Fed. Brian?
Hey, Zack, as you were mentioning, the New York Fed was paring back some of its repurchase operations yesterday and announced that, if you remember that eye-popping $1 trillion figure for overnight funding, it announced it would actually be suspending its afternoon operations. It was supposed to be $500 billion in the morning, $500 billion in the afternoon, simply because those broker dealers and those banks simply weren't asking for that much money anymore. So we actually had some bids in the morning yesterday of only $15.9 billion, again, out of an offered $500 billion, and then in the afternoon, $21 billion of an offered $500 billion. So the New York Fed saying we don't need to offer all of these lines so we can take some of these out of the equation. But as you mentioned, we do have a guest here to talk with us today about not just what's been going on technically with the Fed, but broadly what's going on with the U.S. economy. And that is Atlanta Fed President Raphael Bostic. President Bostic, great to have you join us today.
Hi, Brian. It's really good to see you. Good to be here.
So I want to kick things off just by asking, so you are the head of the Atlanta Fed, and for those that aren't aware, regionally, that covers Alabama, Florida, obviously Georgia, portions of Louisiana, Mississippi, and Tennessee. Just asking, how are things in the South? What are you hearing from Main Street in those areas and in that portion of the country so far?
Well, in the South, we're hearing a lot of the same things that we're hearing from the rest of the country. Businesses are worried. The shutdowns have really hit their cash flows pretty significantly. Households are very concerned. Nonprofit sector is very concerned. But for me, all eyes have got to be placed on the public health crisis and its response. And so across the South, there is a fair amount of variation in terms of how stringent the lockdowns have been. And so what we've seen is really a wave of the move of the virus through. And it's meant that there are really some issues around how quickly we might be able to respond. But the basic response that I'm seeing across my staff is, there's been a lot of forbearance as much as possible among businesses, but we really need to see the stimulus supports that came through the CARES Act really start to touch people, and I'm hopeful that will happen sooner rather than later.
Yeah, well, when you talk about that support from the CARES Act, that also came in conjunction with the Federal Reserve announcing its $2.3 trillion in funding last week, a lot of that using some of the $454 billion in appropriation from Congress. The Fed still has yet to set up its Main Street lending facility. And I'm just wondering, though, based on the business contacts that you talked to, a lot of them maybe haven't got their PPP loans yet. They're waiting on the Main Street lending facility to be set up. Do businesses need more help? Is it almost too late so far for those businesses to stay in business and keep employees on payroll?
Yeah, I don't think it's too late. So you're asking really two questions. One is, are the supports that we're setting up going to get there in time to save businesses? I think the answer there is yes. And my hope is that even for those businesses who might have felt like the 11th hour had already passed, they will see this as an opportunity to get back into the game, get themselves reestablished and destabilized. The second part really is there more that's needed? And what I would say to that is it looks that way. As we've gone through this crisis and started with our responses, one of the things that I've tried to do very aggressively is get a sense of, if we know that certain segments are being supported, where are the other places that there might be concerns or weakness that we should be thinking about? And as I do that and as I have those conversations, I still hear concerns from small businesses, many of whom aren't sure that there's going to be enough in the PPP. I hear concerns from nonprofits and those that are in frontline service sectors like childcare. And then clearly there's been a lot of attention placed on the gig economy as well. Those are all places where there's concerns. And I would also add the municipal side, so state and city governments as well, because we're not seeing the same sorts of tax revenues, they're under funding pressure too.
Sorry, I muted myself. I wanted to ask about muni debt that you just mentioned. So a lot of municipalities have been worried about that, but the terms of the $2.3 trillion last week specified that only cities with above 1 million, for example, in population would be able to be eligible to have some of their muni debt bought up through a special purpose vehicle at the Federal Reserve. Do you feel like there should be more support coming for those municipalities? And if not, what other types of liquidity problems could you see arising that the Federal Reserve might need to address in the future?
Well, let me say two things on this. First, states are participants in the program as well, and they have the ability to transfer some of their funds through this program to cities that can't get the direct funding through our municipal program. The second thing I would say is we've already acted earlier with a money market facility that allows support for businesses or for investors who own short-term government debt. Now, all that said, there's still a lot of pressure and tension, and I know there are a lot of conversations that are happening between policymakers in Washington and state and local government officials to determine whether the sizing of this has been sufficient. And I'm hopeful that they, first of all, have an answer. And if the answer is that there is more that needs to be done, that they give authorization for that to happen.
Yeah, I'm glad you bring up the fiscal measures being taken or looked at right now, too, because we did get the update from the IMF saying that this could potentially be the worst recession that we've seen since the Great Depression. They projected that GDP across the board would shrink 3% this year. That would dwarf by far the 0.1% contraction that we saw back in the financial crisis in 2009. So curious to get your take when you weigh the fiscal and monetary sides here and the fact that the U.S. is slated to post its worst deficit since World War II. When you think about other countries like Germany who had been bracing for something like this, a doomsday scenario, saving, making sure that they weren't running deficits for years leading up to this, how does that, coupled with the fact that the Fed's balance sheet is now sitting at a record $6 trillion, maybe balance with a deficit and a balance sheet that bloated here, what could that do for the U.S. In years down the line?
Well, I think that there are really, I think about this in sequence. So first of all, we have to get the current situation in order. And, to the extent that that requires providing bridges between bridges for businesses between the pre-virus stage and the post-virus stage, we need to do whatever we can to make sure that the collateral damage coming through that is not permanent or lasting. And so that is going to be expensive. We're a very large country. And the amount of support we're going to have to offer is going to be significant. But all that said, I think it's important to remember that before the crisis, the economy was growing in a stable way, and we were seeing growth that was actually a historic in its tenure. And that suggests to me that if we can get to the other side and have as little collateral damage, as few of the small businesses that decide, I got to close my doors, that we can see a rebound that looks more positive. Now, if that happens, we still have to deal with the cost of this. But I think that dealing with that from a position of growth and strength is much preferred to dealing with it while still being in a situation of crisis. Then the last thing I would say, and Chair Powell has been pretty clear about this regarding our balance sheet, we are doing these things in an emergency context, and many of them have sunset times on them. So I'm not expecting our balance sheet to remain at this size. I think as we get into the recovery phase, I think natural course of events will lead our balance sheet to start to shrink as we can pull some of these things out and let parts of the economy stand on their own.
President Bostic, when do you think that might be? I mean, I know that's difficult to predict because of the unpredictable nature of this virus. But, if we do end up seeing the U.S. economy contracting by 5.9% in 2020, as the IMF is projecting, at what point do we, A, get the recovery, and then B, have a sustained recovery long enough where the Federal Reserve can unwind its balance sheet or maybe take away some of these 9 liquidity facilities that they've opened so far?
Well, Brian, I think you said it right in the beginning of that question, which is a lot of this depends on our public health response and how quickly we get to a place where people feel confident that they're not at risk of contracting the virus by walking down the street or going to the store, going to a ball game, or going to their place of work. If we can get to that point, and in Georgia, what I've seen is our peak is projected to be somewhere toward the end of this month. If we can get to the peak and sustain a positive response, late summer, beginning of Q3 could be a time when we start to see things turn on again. But for me, I'm trying to look at all the markets in my district to really try to understand better sort of what that trajectory is going to look like and whether the peaks are going to come sooner so that we can get to the end of this sooner. If that gets extended, in some parts, then we may have to wait longer, and that recovery arc will take longer.
The last few weeks have felt like years seemingly, but people have forgotten that there is another scheduled FOMC meeting that's coming on April 29. As we head into that meeting, you guys are about to go into a media blackout. I'm wondering, what are you watching? What more could the Fed do here if you do see a need for that? Are there other things in the toolkit or other types of tools that you would advocate the Fed use now that it's already at the zero bound and expanding its balance sheet?
Well, one thing, Brian, is funny. I was talking with some of my staff, and they've started setting up things for Sunday afternoons because we seem to have a meeting every Sunday for a while there. So the regular cycle is something that I'll be happy to get back into. What I would say is, we are surveying continuously, and I think in terms of actions, I don't think that there's any special extra weight that we're giving to our regular meetings. Instead, we're going to act as soon and as aggressively as we can. One thing that we learned coming out of the Great Recession was that Fed policy is most effective if it goes big and it goes early. And so we're not going to try to time this. We're going to try to get out as soon as we see a problem and there's a solution that we have tools that are appropriate to address. We're going to get out there and do that. So we'll continue to monitor. Things are happening in an incredibly rapid way, and so I have no idea what sorts of things we'll be wrestling with when we get to that meeting.
Yeah, I don't think anyone will doubt that you guys went big and you went early. I mean, just looking back at those emergency rate cuts that kind of kicked the Fed's response off, it was interesting because we necessarily hadn't seen a lot of the data, public data, come out yet that would kind of point to making a decision like that. Of course, we've gotten record unemployment claims since then, and it all kind of pans out. But I'm curious to see, just to follow up on Brian's question, what kind of data will be guiding you moving forward? Would it be mortgage defaults, more stress in the bond market? It seems like we've moved beyond just looking at job reports and unemployment claims. So curious to see what's gaining interest right now.
Yeah, well, for me, I would say that the job reports and the claims are not providing a lot of real information, because we knew from the prescription by public health officials that there were going to be lots of folks who were going to be idled. And so I think these data are really just verification, validation of that reality. But we are looking, and I continue to look at stresses in mortgage markets, for example, the number of families and businesses that file for forbearance. That will have implications for how mortgage servicers, for example, are able to fulfill their obligations. Again, I mentioned before the nonprofit sector. Their business model is quite different than what you might expect from a for-profit business. And so the types of loan terms that you might see in a PPP or a Main Street program aren't really going to work for them. So we're going to have to think about, are there ways that we can restructure or provide carve-outs so that we don't lose important activities in those sectors? Those are just two of the examples where I think we're going to continue to have conversations about what types of things might make sense to try to make sure that we bring forward all the parts of our economy and our society so that on the other side, we are as whole as we possibly can be and have our recovery be as robust as it can be.
And then President Bostic, lastly, you have conversations with district contacts, whether or not that's households or businesses, small and large. I'm wondering, in these conversations with these times being as trying as they are, what are you telling those businesses and what do you tell them about the Fed's role in addressing the COVID-19 crisis?
I tell them a couple of things. First, I tell them that the Fed is open for business. We are working hard. We are monitoring and aggressively trying to provide support wherever we can. I also tell them that we are having ongoing conversations with the banking sector and encouraging the banking sector to extend credit, to work with their customers, to try to help bridge them through all of this. And, we talk to bankers a lot on this point as well to say, look, we're in an emergency situation. A lot of the things that you might expect us as regulators to say in assessing your portfolios, we're going to view it differently because we understand that this is unprecedented times and it requires dramatic and drastic action. So I say, hold tight, continue to have hope, continue to engage, and we're all going to work together to get through this.
All right, there you go. Reasons for optimism from Atlanta Fed President Raphael Bostic. Thank you so much for joining us. Appreciate you taking the time.
It's a pleasure to talk with you, Zack, and good to see you, Brian.
Yes, our thanks to Brian Cheung as well for lining all that up. Appreciate it.
Hey investors, Zack Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.